Welcome to this explainer. Okay, imagine for a second waking up in the year 2026. You've got no money, absolutely zero investments, but you still possess all the financial knowledge and hindsight of today. What would your exact first move be? Well, today we're going to unpack a step-by-step do-over playbook for building wealth completely from scratch. We'll utilize recent insights to show you how to start over and build a rock-solid financial foundation, totally skipping the usual stress and guesswork. Let's get into it. Here is our roadmap for today. We'll be covering saving versus investing, what you need to do before you invest, the ETF advantage, making your very first investment, and finally, the essential rules for long-term wealth. All right, kicking things off with section 1, saving versus investing, and the actual math behind it. Picture this. It's the start of a brand new year. You've been working hard, you've budgeted like crazy, and you finally managed to set aside $1,200. Awesome. But now you're faced with a really crucial fork in the road. Do you save it in a traditional bank account, or do you invest it in the market? The fundamental question we need to answer is, which of these paths actually moves your life forward, rather than just keeping you treading water? Think about this 3% figure for a moment. This is the projected average inflation rate for 2026. You really have to think of inflation as an invisible thief, right? It's not some dramatic overnight bank robbery. It is a slow, methodical skimming of your purchasing power. That 3% slowly pushes up the cost of your rent, your weekly groceries, and yes, even that $4 morning coffee, which might suddenly cost $4.12 by the end of the year. It kind of doesn't seem like much month to month, but it relentlessly adds up, silently draining the value of the cash right out of your pocket. And this highlights a pretty stark contrast of what happens to your hard-earned $1,200 depending on where it lives. If you're old school and hide that cash in a physical piggy bank, your $1,200 remains exactly $1,200 12 months later. But because everything else got more expensive, you actually lost purchasing power. Now, if you're a bit more strategic and use a high-yield savings account yielding around 4 or 5%, your $1,200 grows to roughly $1,254. That's definitely better. It protects you against higher prices. But let's be honest with ourselves, it is not truly building wealth. To build real wealth, you need to own a piece of a business that is actively growing, taking your returns from a safe 5% to a historical market average of around 7 to 10% annually. Let's move on to section 2. Before you invest, where we clear out the roadblocks. Listen, if you are carrying high-interest debt, maybe like a 23% credit card balance from a wedding or a vacation, you are actively moving backward. Paying it off first is absolutely mandatory. Think about it this way. Debt is essentially a slow puncture in your car tire. You can keep stopping the car to pump it up, trying to invest a little here and there, but it's just gonna keep leaking, dragging you down, and you might never actually arrive at your financial destination. The math just doesn't work if you're trying to earn 10% in the market while handing over 23% to a credit card company. So the crucial point here is to complete this mandatory pre-investing checklist. First, plug the tire by paying off that high-interest debt. Second, you absolutely must build a 3 to 6 month emergency fund, parked right in that high-yield savings account we talked about earlier. You do this because, well, life happens, right? When your laptop suddenly dies and you need an $800 replacement, or you get into a fender bender, you do not want to prematurely cash out your investments. Selling investments disrupts your long-term compounding growth. So this cash buffer, it's your ultimate defense shield. Okay, on to section 3, the ETF advantage, and how to instantly lower your risk. A massive mistake beginners make is chasing individual hyped-up stocks. Investing in single stocks is incredibly risky. Sure, some companies like Apple explode in value, but let's take a look at the trajectory of Palm. Back in the 2000s, Palm tried to sell companion phones. It sounded brilliant at the time. Even huge celebrities like Bono from YouTube invested heavily to the tune of $460 million. But they just couldn't compete with Apple and Samsung. They were sold for a fraction of what early investors hoped for, and within a few short years, the entire brand just vanished into thin air. If you put all your money into one company and it fails, you literally lose everything. So how do we avoid losing everything on a single failing stock? You utilize an ETF, or exchange-traded fund. Think of an ETF like a giant basket. Instead of buying one single stock, an investment company puts hundreds of top companies into one basket, and you buy a slice of that whole basket. For example, an ETF tracking the S&P 500 gives you exposure to the 500 largest publicly traded companies in the US. We're talking Apple, Microsoft, Amazon, all at once. This instantly lowers your risk because if one company struggles, the others balance it out. Plus, it saves you countless hours of research time.
You just buy the basket and let the broader economy do the heavy lifting for you.
Which brings us to section 4, making your first investment, going step by step. Now, right before you click buy, you need to pay very close attention to something called expense ratios. This is basically the small annual fee the fund charges for managing your ETF. The difference in these fees is pretty staggering when you look at a $14,400 investment. Picking a low-cost fund with a 0.05% fee will only cost you about $7.20 a year, but a fund with a seemingly small 1% fee, that jumps to $144. Over decades, that 1% fee will literally rob you of tens of thousands of dollars in compound growth. A great rule of thumb to remember is to strictly choose ETFs with an expense ratio under 0.5%.
Okay, so to buy an ETF, you need an account to hold it in. Think of it as your digital shopping cart. You've got two main choices here. First up is the Roth IRA. This is absolutely incredible for retirement because the money you put inside grows completely tax-free, and you can withdraw it penalty-free after age 59 and a half. The catch? The government does put an annual limit on how much you can contribute. The other option is a taxable brokerage. This offers total flexibility, there are zero contribution limits, and you can withdraw your money anytime. The downside is you do have to pay taxes on your profits. For most people aiming for long-term wealth, starting with a Roth IRA to capture that tax-free growth is a total game changer. Let's strip away all the mystery from the actual process because it truly takes less than 5 minutes. Let's just use Fidelity as an example. Step 1, open an account online and fill in your basic tax info. Step 2, link your checking account and transfer your funds right into your new shopping cart. Step 3, go to the quote section and type in the ticker symbol of your chosen ETF, like SPYM, which tracks the S&P 500. Step 4, select market order. That simply means you agree to buy the share at whatever the current market price is right this second. Hit submit, and boom, that's it. You are officially an investor.
Finally, section 5, rules for long-term wealth, where we master your mindset. The absolute easiest way to succeed and to ensure you actually follow through month after month is to automate your contributions. Set up a recurring transfer so you don't have to rely on human willpower, because let's face it, willpower fades. Treat this automated transfer as a literal salary for your future self. You wouldn't skip paying your employees, right? So don't skip paying yourself. And perhaps the most critical rule of all, never ever panic sell during market dips. If you look at historic market drops, like the sudden crash in 2020 during the pandemic, the investors who panicked and sold locked in their losses and completely missed the massive, record-breaking rebound that followed shortly after. Which brings us to what the investing community jokingly calls the Costanza strategy. If you remember that classic Seinfeld episode, George Costanza realized his natural instincts were always wrong, so he decided to do the exact opposite of his gut feelings, and suddenly his whole life turned around. Well, investing works the exact same way. When the news headlines are screaming that the sky is falling, your gut is going to tell you to sell. Do the opposite. Ignore the noise. Just keep buying consistently. Consistency always beats trying to time the market perfectly. And why is this consistency so vital? Because the math of compound interest is just staggering. If you can automate your system and consistently invest just $1,000 a month over 40 years, assuming a historical average 10% return, you will just have a nice little nest egg. You will build roughly $5.3 million. The numbers really don't lie. It starts off slow, but over time your money begins making money, scaling exponentially into life-changing wealth. So, knowing the enormous cost of waiting and armed with this exact step-by-step playbook, we are left with just one final thought. You know that saving alone won't get you there. You know exactly how to avoid the trap of single stocks by using ETFs. You know the exact 5-minute clicks required to open an account. So what is actually stopping you from conquering your hesitation and buying your future self their very first share today? The roadmap is clear. The next move is completely up to you.
Everybody wanna flex with the cash in hand. Big dreams, big house, big business plans. But $1 million ain't forever if you spend 2, 3. Gotta plant every dollar like a money tree. Inflation rising, prices never sleep. One bad move and the losses run deep. So